Hello, hello, hello. 1 second as I get everything situated. Just make sure the sound's correct. We'll start here shortly, and then I'll get all the live stream links out and such. Give me a couple moments and minutes. We'll start here shortly. All right, one more sound check, and I think we're good to go. All right, let's get this joint going. All right. What's up, everybody? Art Turner, Data Productions Media. Dreams are tangible aspirations where we scheme our dreams into existence. You already know what it is. It's the Data Capital Conference Call, number 24, Sunday, February 23rd, 2025. And you know that I have a banger for you guys today. As always, christening the conference call Starting off with some gematria, the high energy, Data Productions Media, Capital Investments Monthly YouTube live stream stocks presentation equals 333 in English reduction. So you know we have the energy on these calls. If you're not on these calls, you're missing out on a lot of knowledge, a lot of education, and a lot of discussion. But we're going to keep doing these every month because I love doing them, and they help me grow as a person, and I hope it helps other people grow as well. As always, the disclaimer, I am not a financial advisor. All investing, trading risks you take are on your own. These conference calls are for education and entertainment purposes only. Any information discussed to be used is at the discretion of the individual, not Data Productions Media Capital Investments. Data Productions Media Capital Investments has zero liability in any outcomes from anyone using information discussed in the conference calls. All right, just a brief rundown of the meeting 24 outline today. We're going to be talking about super investors, average backgrounds, investing, stocks versus books. I'm in the book world now. We're going to do our book reading, Inside Wall Street by Robert Sobel. Got the book right here. And not only that, it is also signed by Robert Sobel at the on the front page right there. So this is my copy in my personal collection. So we're talking about that book. Going to Rare Books USA eBay monthly store reports. We're going to Rare Books USA business objectives moving forward. We're going to get into the data cap Divi pack. We're going to do I only have one dividend stock right now, so we're not going to worry about the top two performers, bottom two performers. I consolidate everything. And so we're going to grow that back out again with the knowledge that what I like investing in the dividend world. So I consolidated everything into one stock I hold in my dividend portfolio now. And then you guys will be getting an updated video, fundamental video on that later this year. All right, let me just make sure everything's set up for us. All right, I'd just like to check the sound. Okay, very first slide of the day. Super investors, average backgrounds. So I kind of like this topic because in the financial world, in the investment world, you see the top guys, you see the Warren Buffetts, the Peter Lynches, and all these hedge funds and hedge funds managers. Of course, they make a lot of money off of investments. And if you know a little bit about the stock market, we understand that the stock market is the greatest wealth generator in the world. The average person can get wealthy off the stock market with not so much high level financial skill needed. You just need some, some hard work, some research, and some basic understanding of math and valuation. But you don't have to be a very smart genius individual to have a super investing record. And so I'm gonna go through a couple examples today of people with average backgrounds, normal people who have turned into super investors. Okay. So I'm very excited about this, and I hope this gives other people inspiration moving forward in their investing careers to stay the course, because it will pay off if you just allow things to compound and you put your capital in the right direction. You're allocating it in the right direction. So the first super investor with the average background I want to go over is Ann Schieber. She transformed her modest savings into a $22 million fortune over 5 decades. And before we get into her story, I just have some gematria to christen it. We have average, AVG, the acronym for average. Average humans can be a super investor, equals 333 in English ordinal and 117 in reduction. We understand that that is a powerful decode with the ordinal and English reduction. So we're in the right place. It's telling us some sort of energetic truth that, you know, average people can do above average things if they just put their mind to it. And so for Anne, you know, she retired in 1944 at the age of 51 from a low-paying auditor position at the IRS. Sheber began with a $21,000 portfolio. Despite never earning more than $4,000 annually and facing workplace discrimination as a Jewish woman, she exemplified financial discipline. Sheber's wealth accumulation can be attributed to three key factors, and these factors, you know, span everything for everyone in the investing community. Everybody can do this. She lived modestly, reportedly wearing the same clothes since the mid-1940s and residing in a small apartment she seldom left. Now, this is an extreme example of frugality. I am a firm believer that quality of life, you know, living a good life is very important, and there's balance. All right. But if you want to be a super investor, you're going to have to make some sacrifices. Now, you don't have to do the extreme sacrifices she's made, but you got to be willing to go the extra mile and, you know, save a little bit more to put in your investment account for later. You don't have to wear the same clothes for the rest of your life. You know, you don't have to live in a small apartment, denying yourself of some more of the luxuries. But you have to understand, you know, you can't have every luxury if you want to be in this game, especially if you're not making up a lot of money. So keep that in mind. You know, don't be afraid. Don't have fear of frugality. You can still do the things you want, but you're going to have to be willing to sacrifice somewhere, especially if you're not making that much money like she wasn't. So she had to go to the extreme. And the next one is longevity. She lived to 101. She allowed her investments to compound over 50 years after she retired. That's important. You know, longevity is important to the game of investing because when you think about it, I was actually just recently listening to an interview on YouTube, and a hedge fund was talking. A hedge fund manager was talking about what long-term time frames are. He said 20 years, when you really look at it, is not a long-term time frame to allow companies and to allow markets to flesh out. Yeah, it might seem a long time to a human life because, I mean, say if you live to 100, that's a fifth of your life. You know, people, let's say people live to 80, that's a fourth of your life. That's a quarter of your life, 20 years. So that's saying that's not a long time. That, you know, scares a lot of people off. You only live one life, and do you want to wait for things to pan out over 20 years? You have to have patience. But when you look at the Michael Jordan of investing, Warren Buffett, he's 92 now. Charlie Munger, RIP, he died at 98. Their lives, their longevity plays a role in this game of investing. It's almost like sports. When you look at LeBron James and what he's been able to do, part of it, what he's been able to do is he's been in basketball for a long time. He's 40 plus years old, still playing in the NBA at a decently high level. Whether you like him or not, that's part of the game. Getting the extra stats, allowing them to build up where, you know, Michael Jordan, where he had an amazing career, he's still considered my GOAT. He didn't have the longevity like LeBron James. So his stats in the game of basketball aren't as good, not as compounded as LeBron James. It's the same thing in the investment world, and I equate the investment world much like the sports world. Different individuals have different thoughts, beliefs, different perspectives on how to invest in the game, but to be able to see the results, it's going to have to, it's going to be over a long period of time. You have to be in the game 20, 30 years to really see the results. And so if you want to be an investor, you have to think about your health too. Health is wealth. And that's why I love the game of investment, because it's everything that culminates in life. So I hope and pray that I'm able to live a long life to see my decisions in investing play out positively. Okay. And so keep that in mind. Longevity is very important. And she had another 50 years after her retirement to see things compound. And now let's get into compound interest. That's the third key factor in this equation for her. By reinvesting dividends into a diversified portfolio of high quality stocks, she achieved an annual return of 14.6%, nearly double the S&P's average of 7.5% during that period. Usually the S&P compounds the stock market, compounds over a lifetime, at 10% per year. If you're in the SPY, in the ETF, well, that's going to take about 3 basis points, about 3% off. So that 7% for fees, so that 7% does play out. So she pretty much doubled what you could get on the SPY. That's super investing, especially over a long period of time. Now, what was the outcome of all of this, right? To my knowledge, she wasn't married. She lived a very lonely life, but she had a whole lot of money, 22 million at the end of her life. So upon her death in 1995, Sheber bequeathed her whole entire fortune to Yeshiva University to support scholarships for Jewish female students, aiming to help others overcome the job discrimination she had faced. Her story underscores the power of disciplined saving, prudent investing, and the impact of compound interest over time. It's just a photo of her. So keep those 3 things in mind. Frugality, saving, having a long-term life and, long-term horizon. You might not live to 100, but you have to be able to hold your investments for a long time, 20 plus years, and compound interest, reinvesting your dividends, not selling out of stocks just because, making sure you're not being a forced seller, investing what you can afford to lose so you do not have to pull it out later. Those are 3 key things that you can do to be a super investor from an average background. And you can still live a positive life, a life with joy. You don't have to go the lengths that she has went, but you can still get similar results, especially if you make more money. The more money you make, the more you can put in. So keep that all in mind. We have more examples though. All right, so the second example is Ronald Reed. Ronald Reed, another super investor from an average background. Ronald Reed was a lifelong resident at Brattleboro, Vermont, worked as a gas station attendant and a janitor, leading a modest and frugal life. Despite his humble means, he quietly amassed an $8 million fortune through prudent financial habits. Reed was known for his thriftiness, often driving a secondhand car, wearing old clothes fastened with safety pins, and cutting his own firewood well into his 90s. Now, what I would like to bring up is you don't have to go to that type of frugality wearing old clothes with safety pins. You can make the decision, having a little bit less money at the end of your lifetime so you can wear better clothes to feel better about yourself, that's okay. So you don't have to go to those means if you don't want to. You just have to know the different decisions and consequences for what you do. If you're not making a lot of money, if you're a gas station attendant and janitor, which is okay, and you still want to invest, then maybe, yes, you have to wear clothes fastened with safety pins and whatnot. But if you have a better job, you can wear the better clothes, but you want to make sure you don't want to get caught up into that lifestyle creep. And I think cutting firewood well into your 90s is good. That's great exercise, and that's health, right? And so his health of him chopping his own wood into his 90s has produced his wealth. Health is wealth. So, that's good for Ronald Reed. He invested in dividend paying blue chip stocks. He held them for a long time, decades. At the time of his death, his portfolio included companies like Procter and Gamble, J.P. Morgan Chase, GE, General Electric, and Dow Chemical, all titans of industries throughout his life. Upon his passing in 2014 at the age of 92, so he at least made the Warren Buffett age. Buffett's still alive at 92, but he at least made it to that point. He bequeathed $4.8 million to Brattleboro Memorial Hospital and $1.2 million to Brooks Memorial Library, marking the largest donations either institution had ever received. Think about that. A janitor and gas station attendant made the largest investments, the largest donations in the history of a hospital and a library. A super investor from an average background, right? And you think about it, throughout history, the billionaires and the big titans of industry, they always have philanthropists at the end of their name because they have so much money they can just give it away, normally for their own ideas of what they want to do. The Carnegies, they built their own schools and have had their own curriculums, but they really want that philanthropy title. Just say, oh yeah, we're so charitable. Well, this guy right here, very modest life, was able to be a philanthropist with the big dogs in that sense. So that's awesome when you think about it. Saving, prudent investment, modest lifestyle, but of course you have to pick good companies. P&G, Procter & Gamble, still doing well today. All the different brands they have, Clorox, just so many cleaning supplies. They have so many different brands. They're not going anywhere. J.P. Morgan Chase, still a big bank today. They have their own investment funds. GE, General Electric, Dow Chemical. So you have to pick the right dividend payers, but that's part of the game. And so again, another super investor from an average background. This is going to be my last one, but it's one of my favorite. So this super investor with an average background is a part of the data productions media data capital community. Paula Rose. When I had this, she was 69 years old, but she just turned 70 recently, this past week. So happy birthday to Paula. You're now 70 years old. You're still invested in crypto, and you're a very active member and part of my community. And I'm happy to have you, and I'm happy to share your story, because your story is not just individualistic. It's not just your story. It's your family's story, and it spans over 3 generations. It started with her parents, who had a modest life, both teachers, kids, but they understood the power of investing. And for Paula, she never made over $30,000 a year in her life, but she still has been able to do really well in the crypto markets, well in the stock market, benefit from the investments of her family, but also she'll be able to move forward in life and give her, assets and portfolio to her daughter when she eventually passes in a long time from now. You know, she's in her longevity stage. But you know, whenever that day comes, a long time from now, her daughter will be set up nicely. And I'm happy to be a part of that and in helping continue on the generational wealth that she's building for her family. And so I want to bring up and talk about her story a little bit. And you know, she explains in our Discord that you can join where that came. And so yes, her parents, this is, I mean, she's 70 now, so this is like in the 40s, 50s, right? And they're teachers. Her parents set up an IRA when she was in college age. But when her mom passed, there was about $25,000 in a beneficiary account. That was about 27 to 28 years ago. That was 25K and was unable to be cashed out in something that was unable to be cashed out. And so something was set up where she could take out a small amount yearly. And she's been taking about $1,500, $1,500 yearly. And today it still has $28,000 left. And so there's a couple of things I want to point out. The power of investing. 28 years ago, the account only had $25,000. And via life circumstances, again, life things come up. You need to pay bills. She had a daughter, so she had to pull out over $1,000 yearly to survive. But over that time, taking out that much money, she still has more money in the account than what it started with after essentially disrupting the compound interest every year. So that's the power of investing. That's the power of the stock market. Even though she had to pull out money and it was hard to reinvest it due to life circumstances, she still has came out on top with more money that she can continue to pull out. That not only helped, her, support her daughter, support her life, but also it gave her time to understand how to invest. And that was from her parents. And now I think what is also very important to understand, and we all have different life circumstances, while she wasn't able to take the frugality route and protect that money, imagine what that money would be at right now if it was never touched. She essentially has pulled out over $30,000 of this account over 3 decades, and it still has been producing money for her. Imagine where that would be now. I mean, I'm sure that's in the hundreds of thousands, maybe a million, right? And so I would hope anybody that sees this, if you're able to protect your money in a way where you don't have to pull it out of an account like that, imagine where it would be at the end of your lifetime. So there is 2 sides to this equation. The benefit of being able to, live a life off investing stock market and live a life via what your parents have been able to do for you, even off little amount of money, just having the dream, the dollar and the idea of what to do. It spans generations. And if you're able to protect that money, it can compound and, explode even more. And, me and Paula, one of her things she wants to do this year, she wants to visit her daughter abroad. Her daughter's doing a master's program for education, and she wants to travel abroad to spend some time with her. And so that's our goal this year. We're making the right type of investments so she can do that. And, I am fully confident that we'll be able to make that happen for her within the summertime. She's been an amazing, active member, a part of the community. We've made thousands of dollars together and we're going to continue to do so. And we're just in our longevity phase now, and we're going to start compounding in the future. And so thank you, Paula, if you see this, for allowing me to share your story. You are a super investor with an average background, but your family, even off modest, income, are super investors with an average background. And if many families have take the stance and that your family has taken over 3 generations, imagine where they be. Because there's a lot of families out there that have made a lot more money, but have nothing to show for it, especially after, let alone 1 generation, 2, 3 generations. So this is something to keep in mind. And if you're young, hopefully you see this and, you have a vision for yourself. And if you're young and have a family, hopefully you can see what's possible if you have a target and a direction. So thank you. Super investors, average background. All right. This is this is going to be one of the favorite parts of the presentation today. Investing, stocks versus books. The pros and cons to equities and books as investing vehicles. And to christen it off, I got to give the gematria. Stocks and books are investments equals 333 English ordinal. We know the number. That's powerful. So we know we're in the right place. Stocks and books, those are great ends, bookends, pun intended, of how to make money and how to span generations investment-wise. Some key considerations before really getting into it. Investment goals. Are you prioritizing growth and liquidity, or is the value of tangible assets in niche markets important to you? So do you want growth and liquidity so you can get in and out and you have a higher chance of growth? Or do you like tangible assets that you can touch, and that, you're not probably going to lose a whole lot of money on them? And do you like niche markets? Do you like a story behind it, per se? Time commitment. It's another consideration. How active do you want to be in your wealth accumulation? Your risk tolerance. Can you handle volatile markets and prices? And passion versus profit. You want to balance out financial gain with the love of the game, right? So you got to balance that out. These are all key considerations people need to look at when investing in stocks or books. So let's talk about the pros to stocks. Liquidity. Stocks can often be bought and sold quickly, providing easy access to cash. There's a potential for high return. With the right investments, stocks can offer significant appreciation and dividend payouts over time. We went over super investors, average backgrounds. A lot of those investors have dividend-paying companies that they've held for decades. And if you allow those to appreciate, man, you're going to have an explosion of money at the tail end of all of that. It's like a snowball rolling down the hill. It just gets bigger and faster and bigger as it continues to roll down. Diverse opportunities. You can diverse across industries, geographies, and risk levels to minimize potential losses. So, diversity is very important in the stock market if you want to limit your risks and limit your losses. Okay. You can buy a couple shares of one stock in one industry, in another. You can do international. You can do bonds. You can do ETFs. There's a lot of creative ways to procure a stock portfolio to your liking. There's passive management options as well. Index funds and ETFs allow for hands-off investing while still participating in the market growth, right? You could just what's the word for it? Outsource the active investment part. Give it to the people who went to school who have a lot more experience in it with these ETFs, hedge funds, and such. And you just want to see your money grow over time. It's not going to be as large if you are active yourself and doing it yourself, but you'll still get that long-term trajectory up, and you don't have to worry about it. And you can go about your life and live it. And a lot of people love doing that. They want to live their life, but they want to make sure they're doing the right things with their money. And the the positive, the stocks, what people love is the growth potential. Historically, stock markets tend to grow over time in the long term, making them attractive for wealth building. In the long term, especially in America, Warren Buffett has said, always bet on America. They grow over the long term. If it's a good company, it's going to be able to survive and thrive in any era, recession, depression. If the stock price goes down, that could be a potential opportunity to buy if it's the right company. And another thing is transparent pricing, especially in the new age world with all these different brokers, right on the spot listing prices. Stock prices are publicly available and regulated, making it easier to understand the market value. You can go on your phone and you can see different listing prices for thousands of different companies. And a lot of them have great liquidity, so you can get in and out relatively easy. You don't have to price it yourself. The market already prices it for you. The power of compounding. Investing in good businesses that compound over time will increase returns exponentially. That's an absolute over time. Even if a stock is down for a little bit, but if it's a good company, it always comes back. It's just, that is what it is. And that spans hundreds of years of human history with financials, right? So good businesses over time always work themselves out. There has not been many examples where that hasn't happened. If you're a good business, you're going to grow. Now, there might be better businesses out there that grow higher, faster, but if you're a good business, you'll get some type of return in the long term. And ease of scaling. Easy to scale investing business with pure money. And we'll get into that example when we start getting in books, right? Since it's just cash, it's in a brokerage, and it's in a larger business, it's easier to park money there and allow it to grow. A lot of times, depending on the business or investment vehicle, it's not that easy to scale, right? If you're in real estate, you have $10 million, you could, buy $10 million houses, which comes with a whole different other host of problems. You could buy a house for $10 million, which is one, but then the liquidity's messed up. You can't buy $10 million worth of real estate that day on a house and sell it tomorrow. It's not how it works. You can do that, especially in the modern age in the stock market. And I just want to bring up some history, an example. The Bank of New York Mellon Corporation, BK or BNY Mellon, has been listed on the NYSE, the New York Stock Exchange, the longest. It also has the second oldest company listed in NYSE. Its predecessor, the Bank of New York, was founded in 1784 by Alexander Hamilton. The Bank of New York was the first company to be publicly traded on the NYSE in 1972. BNY Mellon was created through a merger in 2007. So, that's over a 200-year-old company. That's that's as old as America, essentially, almost as old as America. And so you see there's a lot of longevity in that. And if it's a great company, it's long lasting, imagine how many generations that could help, right, in your family line. So these are really things to think about. These are the pros to stocks. The cons to stocks. Volatility. Stocks can experience significant short-term fluctuations, potentially leading to losses. Obviously, if you're in the stock market, the prices are going to go up and go down, and you have to stay the course. You have to stay the course. If you get scared and you sell out, maybe stocks aren't for you. That's a con. Maybe you need something a little bit less volatile. Market dependency. Stock performance is influenced by economic, political, and market-specific events. Some other investment vehicles, they're not affected as much as stocks are with the outer world, right? So you have to understand that. And there is a knowledge requirement. Successful stock investing often requires research, market knowledge, and professional advice. You have to do the work if you want to be good at stocks. Even if you want a passive income investment vehicle like ETFs or a fund, you have to research the fund to make sure you're putting it in the right place. So you have to, do a little bit of digging and knowledge. There's also a potential for loss, but there's a potential for loss in all investments. Investments can lose value if companies underperform or markets decline. That's the risk we take. And another con is psychological stress. The ups and downs of the market can cause stress, especially for short-term investors. That's why it's important to never invest more than that you're willing to lose. Because if you invest more that you're willing to lose, you're going to be having some nights where you're not going to be able to sleep. The goal is to be able to invest, but also sleep well at night, regardless of what happens. That's the goal. And so the average lifespan of companies listed in standard S&P 500 was 61 years in 1958. Today is less than 18 years. McKinsey believes in 2027, 75% of the companies currently quoted on the S&P 500 will have disappeared. And so that is a thing to think about. The companies aren't going to be listed on the S&P 500 forever. It's a different time. So that's why you have to be able to understand what companies you're invested in. It's not as long as it used to be, at least for the S&P 500. So to get those long-term compound interest, you got to be able to withstand that if it gets dropped off the S&P, if it stays on the S&P. With a lot of technology companies today, it just causes a lot of volatility. So, stocks does not come without negatives. That's very important to understand. But the positives way outweigh the negatives if you have a little bit of knowledge and you're willing to wait it out. Pros to investing in books. Now, let's have a little gematria to start off. Books can be a profitable investment. 333 English ordinal. Books can be a profitable investment. 333 English ordinal. All right, so this is where we're at. Some pros to the books. They're a tangible asset. Books are physical, collectible items that can retain or grow in value over time. If it's a good book, it's usually going to stay at that particular price where it's at now. And, depending on its rarity, its condition, it will gradually increase in value over time, especially if there's not many copies and it's tangible, right? You can have it with you and you can get it off. That's different than stocks. Niche market potential. Rare, vintage, or first edition books can appreciate significantly, especially in niche markets. And so if you like books and you love the different stories or genres of books, you can get creative in your collections, right? And you can sift out the ones you like to collect. You could like nonfiction, or you could like specific classic literature, or cookbooks or financial books. Like me, I like to collect financial books. So these are the things you can do. You can make money in it, but it's also passion based as well. Low entry cost. Many collectible books can be sourced affordably, allowing for lower risk entry points. Because if you have knowledge of books, a lot of people don't have knowledge of books. So you have a little bit of knowledge of books. If you know what you're looking at, you can get great, amazing books for $1, $2. You can get collections of books for less than $1 a book. You know, for a good company, you're going to have to pay a premium in the stock market, right? If everybody knows it's a good company, you're not going to get the company at a low entry cost unless something happens for a short period of time. That's different for books. Another man's trash is another man's treasure. That's the pros to investing in books if you know what you're doing. Less market volatility. The value of collectible books is less influenced by broader economic trends and more by demand among enthusiasts. If the book is wanted by enthusiasts, you can get the book off whether we're in a Great Depression or not. It doesn't matter. You know, enthusiasts will buy books whenever. There's always someone out there with money if the book is valuable enough or worthy enough. And, you know, there's a dual utility with books. You can invest in books as a monetary gain, and you can invest on a mental gain as well. I love to read. So the reason why I believe I've been such a better investor over the years is because I've read a lot. You know, one of the better reasons why I'm able to do these presentations and flesh ideas out is because I've read a lot. So that's the dual utility. That's a huge pro in books. You know, it can be enjoyed for the content and adding intrinsic value to the investment. You can read it, then sell it. So you got the content of the book in your brain, but also you can get the monetary profit as well. And personalized expertise advantage. Yeah, look, again, knowledge of specific genres, authors, and periods can give you an edge in finding undervalued books. Very important. You can go to Goodwills, thrift stores, and find things that people will pass by because they don't care or they don't know, but that's our opportunity. Intangible longevity. A well taken care of book can last centuries. There's books 500 years old that still smell like new leather smell. You just have to be able to take care of it. All right. And so I bring that up because it goes back to longevity of companies. You know, a book can last a lot longer than a company. A great book could last a lot longer than a great company and still compound at pretty good rates. So, you know, you have to put that in mind. If you're going to take care of a book, you know, it could last many generations at a normally safe risk level too, if it's taken care of. You know, companies aren't meant to last forever. Even the best companies, even the giant companies in the world aren't meant to last forever. Books, you know, yeah, they're paper. They're not meant to last forever either, but they can last a lot longer than companies can. And it's a well-known fact. All right, cons to investing in books. Illiquidity. Selling books can be time-consuming, requiring the right buyer and marketplace. It does take a lot of effort. You know, you have to, if you're an online bookseller, you have to have a platform to sell the book. You have to, you know, take photos of the book. You have to do a description of the book. It's going to take a right type of buyer. The buyer doesn't always come out that day. In the stock market, they have market makers. So if you want to sell a stock, the market maker is just going to buy that from you and they'll sell that to someone else later. You can't do that in the book market. There's no market maker for books. Now, there are, sell back your books. You can sell it to companies and they'll sell it later, but you're not getting that value out of that book if you're selling it to a book company like that, the quote unquote market maker. You're essentially getting that fair value price of a stock where it's trading at that day. You're selling it to a market maker on the brokerage. That's not the case for books. You know, if a book's worth $1,000, if you have a rare book worth $1,000, there might only be like 5 to 10 people in the world that would want that book. And you have to think if they even have $1,000 to pay that, they might send you, if it's eBay, they might send you an offer for $650 to get that book. And you have to decide if you want to make that sell or not. Or you sell it, you hold on to that book, and you might not get that $1,000 till later in the future. But you might be a forced seller if you need that money. Very illiquid. So that's the downside for sure. Then another con is storage and maintenance costs. Books need to be stored properly to avoid damage, especially rare and antique volumes. You need a proper storage space, you know, no moisture, you know, it needs to be dry. You know, you might have a storage facility that's going to cost monthly. You know, if you have rare books that are worth being repaired, that's going to cost money. You know, you can sell books damaged. I sell books damaged every day, but you're not going to get that high price that you would want. So storage and maintenance costs, that's a big con when it comes to books. You know, it's very big. And niche demand. The market for collectible books is smaller, which can limit your buyer pool. You know, they're not out there every day. They have to find you. You have to put yourself in a position to be found, and that takes time and effort, and that takes some knowledge. Also, it's a slower growth potential. While some books appreciate quickly, most gain value gradually over time, especially for the well-known valuable books. Yes, you can get lucky at a thrift store and find a book like I did, Think Grow Rich, for $3, the first edition, third printing, for $3 at a thrift store. But that doesn't happen every day. You know, most if I go online right now, yeah, I can find that book, but that's going to cost $600 plus. So it's not like I'm buying that at the full price today and trying to flip that double, you know, tomorrow. I would have to buy that book at that price and hold it for a long period of time so it could potentially grow in price. You know, that's much different than investing in growth companies in the stock market, or even dividend mature companies that are paying you a dividend over time. So it's a lot slower growth potential if you're buying it at market value during that day. That's different than finding it somewhere it probably shouldn't be, you know. And risk, there always is a risk of depreciation, overproduction, lack of demand, damage to a book can significantly reduce its value. So those are things you have to fight off. You know, especially damage. Maybe over time, Think Grow Rich has lost its luster in the eyes of many. So there's going to be a lack of demand. So me holding on to the book could be a risk. You know, I'm not really worried about overproduction. Yeah, there's a lot more volumes that have came out of Think Grow Rich over time, but that's not affecting the value of the first edition. That affects the value of the later revised editions, but not the first. But if you have a later revised edition and you're thinking that as an investment, if they keep producing it, it's lacking its luster. And there is research and expertise requirement. You know, identified and valuable books require specialized knowledge and effort. You know, even if you do, you know, you can find old books for $1 every day. That doesn't mean it's worthy. That doesn't mean it's worth something. You know, old books could be 300 years old, but it might not be worth something. You know, people might not want it just because it's old. It's just an old book, you know? So you have to have that type of expertise as well, much like the stock market. But it's got to be a little bit more specialized. You have to know what you're doing. And there's real no passive option for this. You know, there's no passive investing option for books where, you know, you do it. I mean, there's consignment, but that's a little bit different. All right, now let's get into the book reading. I'm excited for this. I've been busy. My life's been very busy. So for me to read books like I would used to, at least, once or twice a week for a couple hours, it's been very hard to do with me starting my book business. And so to counteract that, to have like a double duality, utility, a double whammy of positivity for this, I've been reading out loud different books in my collection on live stream. Not only it helps you guys, it helps me keep sharp reading, and you learn, different things about different books. So again, I love to invest in, and I love to collect in investment type books, financial books. They are seen as investments as well. Signed copies are better, first editions the better. In context and content within that niche is important too. So this is Inside Wall Street by Robert Sobel, copyright 1977. And again, it was signed by Robert. He called it Bob, Bob Sobel, but it's, Robert as well. 1977. Continuity and change in the financial district. First edition. There you go. And so my plan is to read the introduction and a little bit of chapter 1, and just to keep the mind sharp a little bit. This is how I've been keeping myself sharp. So we'll see how much we get through. I'm not trying to, make this too long, but, you'll be able to listen to this later, and hopefully you learn something. So we'll start with the introduction. It may well be that New York is in the process of losing its position as a preeminent world financial capital. But if over the next dozen years or so, the city's financial district disgorged some of its banks and trust companies, and those that remained had to share power with outsiders, and should be the two major security exchanges decline, merge, and then become part of a national system centered in Washington or some other place, the politicians still might attempt to preserve the area for tourists. As we know, that didn't happen. This is 1977. New York Stock Exchange still around. NASDAQ. Texas might have a stock exchange now. So there have been a lot of changes, but Wall Street really has not condensed. Not in what he thought this first introduction. Out-of-towners and foreigners swarm through the district throughout the year, providing the city with substantial revenues. These visitors go to the Statue of Liberty and getting off the ferry, head north along Broadway or Broad Street to see the sub-treasury, the exchanges, Trinity Church, and the Nassau Street shopping area, the South Street Seaport and Museum, and the World Trade Center. They can find the romance of history in Lower Manhattan and a flavor of time and life absent from most other parts of the city. The streets, lanes, and alleys of Lower Manhattan indicate much of the story of New Amsterdam and early New York. Visitors can wander through the street, treading on what originally had been cow paths, William, Hanover, Thames, Rector Streets, and others. When the Dutch ruled, there was a large area to the west of Trinity Church that was swamp and estuary, homes for migrating birds. Lobsters and oysters were taken from the waters off Liberty, Carlisle, and Cedar Streets. At high tides, small boats meandered atop what is the site of the American Stock Exchange, and the land to the north and east was dotted with ponds and rivulets. Close to 2 centuries ago, when landfill operations began, Lower Manhattan looked like a small town. The twisting cow paths were about to become streets with small houses and shops on either side. Here lived Washington, Hamilton, Adams, and others in the national government. The cattle still came down Lower Broadway, and there were slaughterhouses on the west side. But then Wall Street was the city's most important thoroughfare. Farmers would take their grain down to the city and now what are Carlisle and Rector Streets, while foreign shipping docked along the East River to discharge coffee, dry goods, and other products. The homes and offices of merchants and petty bankers were located on the street, one of the most important commercial centers in the New World. Some of the men who lived and worked in them became securities dealers soon after. And in 1792, a handful came together to form the forerunner of the New York Stock Exchange. So in 1792. So that's the real humble beginnings of the stock market. I could go a lot more into the introduction, but I want to get to the first page, like the first chapter a little bit, because it's going to go into the little bit of history as well. Actually, we'll finish the introduction because I think it's giving great knowledge. Those whose lives were centered on Lower Manhattan showed no inclination to alter the dimensions of their lanes and streets, and neither did the municipal governments, which they usually controlled. They erected wooden buildings in the first half of the 19th century with offices on the street level and living quarters above. Many of these were leveled by great fires. In 1835, conflagrations destroyed every wooden edifice below the present site of City Hall, and 10 years later, a second fire resulted in widespread bankruptcies in young insurance industry. Most of these residencies that remained were razed during the next generation and replaced by office structures. As the owners moved uptown, often to the countrified atmosphere of Greenwich or Chelsea, the last of the wooden structures were torn down toward the end of the century, as the district underwent a major building boom and entered the skyscraper age. The periodic reconstruction of Lower Manhattan continued throughout the 20th century, with a lull during the 1930s and early 1940s, which was more than compensated by a spectacular effort in the 1950s and 60s. Most of office buildings along Wall and Boss Streets were pre-World War II. However, but on the periphery of the great T-shaped skeleton that is the center of the financial district, there are several major examples of post-war architecture, the most obvious being the World Trade Center. All right. Now I'm gonna read a couple pages from chapter 1. I'm not trying to bore you guys. Need to get the book too. But chapter 1, 1877. We'll see what they talk about. I don't know what they'll talk about, but we'll see. Just we're reading. This is casual. This is casual. Christmas, 1876, in Cornelius Vanderbilt, age 82, rested in bed in his Fifth Avenue mansion not far away from Washington Square. Several doctors were in attendance as they had been the past several months. The notorious Claflin sisters, Tennessee and Victoria, were there as well. Spiritualists and stockbrokers, journalists and politicians, their interests coincided with those of Vanderbilt, who had sponsored their careers and at one time had proposed marriage to Tennessee. Now they use their magic and charms in an attempt to restore his health. I love magic. I love magic. It's part of money too. Magic is part of money. The sisters had placed salt cellars beneath the feet of his bed, and Tennessee had seen to mutter chants. These may have had some effect, for several times that autumn. Vanderbilt was aroused from what the doctors thought was terminal torpor. In the downstairs parlor was Frankie Crawford, Vanderbilt's 38-year-old second wife, awaiting the end with some of her stepchildren, all of whom were older than she. Occasionally, they would appear in the bedroom door to inquire about the old man's health, but most of the time they were turned away. Vanderbilt knew the end was near. He arranged to enlarge the family mausoleum on Staten Island to receive his body and those of his children where they died. More important, he rewrote his will so as to leave the bulk of his more than $100 million estate to his son, William, who was enjoined not to sell off the major holdings. To do so would only enrich the bankers, brokers, and speculators on Wall Street, and Vanderbilt didn't trust any of them. Vanderbilt survived into the new year, but everyone knew he couldn't last much longer. At his request, Frankie played hymns on the family organ, and the sound of them prompted rumors that the old man has died. A reporter spoke to a doctor of his suspicions. Vanderbilt listened at the door and shouted, "That's a damn lie." But on the evening of January 4th, the doctors called the family into the bedroom to say farewell. Frankie sang, "Near my God to thee." Vanderbilt raised his head and whispered, "I'll never give up my trust in Jesus." Earlier the next morning, he was dead. All the city's newspapers carried reports of Vanderbilt's death, and the larger ones published long articles outlining his career, assessing his impact. Vanderbilt had been born into relative poverty and had risen to become a steamboat tycoon, a leader in transoceanic transport, and a master builder. He had been a world figure, fomenting a revolution in Central America and putting together the pieces that went into the making of the New York Central and Hudson Railroad and other Vanderbilt railroads that crossed the Mississippi. He was best known for his financial exploits. However, Vanderbilt had been a central figure on Wall Street for the past 20 years. Together with often in opposition to Daniel Drew, Jim Fisk, and Jay Gould, he had created corners, manipulated major railroads, coerced politicians, bought judges, and participated panics. This is all part of Wall Street. You know, it's not as clean of a game as what people think. You don't have to do dirt, but if you know the Vanderbilts of the world, if you want those type of riches, unfortunately, you're going to have to do dirt, but you don't have to. Like, you can still be moral in the stock market, right? I fully believe that. But you can't be a punk, right? You can't be a punk, but you can still be moral. You know, you can't be soft. He had been one of the half dozen most powerful businessmen in America, and certainly the central one in New York. He who was the head in front of a great company has finally succumbed to a monopoly greater than he. Wrote one journalist, who thought the city would reverberate with the news of his death. How Wall Street trembled as the fact became patent that Vanderbilt was no more. New York was too sophisticated a place in 1877 to undergo trauma at the passing of even so powerful a man as Vanderbilt. And in many cases, his death had been anticipated. And Wall Street did not quiver. The week prior to Vanderbilt's death, official reported volume at the New York Stock Exchange auctions to be at 406,000 shares, or slightly more than 80,000 per session, while outside trading was not unusually large. True, a Vanderbilt road, the Lake Shore, had dominated trading, with 225,000 shares changing hands, but this was due to more unexpected losses rather than fears of a new management. Volume rose slightly when news of his death reached the street. Still, only 98,000 shares were auctioned, with Lakeshore accounting for 36,000 of them in closing firm. The New York Central and Hudson, Vanderbilt's pride, closed unchanged, with 5,000 shares being auctioned. So I'll stop it there for that. I think that's a good, insight to this book. I haven't read this. I'm probably going to have to read this actually, because it's actually kind of interesting, just what I read off right there. But Inside Wall Street by Robert Sobel, talking about Vanderbilt on chapter 1. And he was going through the history of the stock market, how the New York and Stock Exchange came to be. So I'm probably actually gonna put this on my reading list for some time in the future. If you already have this book, if you don't have this book, go get it. And hopefully you liked this reading. All right, let's get into Rare Books USA eBay store monthly reports. Let's, art sales, antique and vintage books, 333, English Ordinal. We understand that. Rare Books USA is an eBay store and is a subsidiary of D.A.T.A Productions Media. Earnings report style monthly updates, tracking sales, expenses, future business advancements, and our 2025 forward guidance is going to be $25,000 of revenue on eBay. That's what we're going for. And so for the next couple slides, we'll get into the nitty gritty of what this past month of February has done. And so this is the month of February. Obviously, we're not done yet. We still have, about 5 days to go in February. But I will say, February was looking a lot more slow than I was anticipating until the last couple of sales, the last couple of days. So first, I want to show, for the first 23 months of February, we've done $1,562 in sales on eBay. The net sales is $1,100 when I'm taking home from after all the fees. The average sale price is $33.96. So my historical average has been around 28, 29, around that range, the high to mid 20s. But with the last couple of sales that we've had, it jumped up quickly, and we'll get into that. But when we talk about what the year-to-date totals right now from January 1st, 2025 to February 23rd, which is today, we've done $3,460.53. We've had net sales of $2,321.38. I've sold in total 114 books on the year. The average sale price on eBay for the year thus far is $30, which is a couple dollars average from what it was last year in 2024 for half of the year. And so the balance sheet, that's not going to change a whole lot. But I also want to say, our assets right now are about $8.8 thousand. And while it doesn't show up here, my inventory that's listed is also assets as well. I just have it as a general expense for now to make accounting a little bit easier and understand my cash flows moving forward. But when it comes to tax time at the end of the year, my general expenses, what I haven't sold, goes straight back into assets. And so you'll see that in the income statement right now. So the income this year, gross profits just a little over $2,000. The operating expenses, is $2,300. And so right now, we're looking at what the net income. Let's go in there. Net income. So we're negative $294. But also remember the general expenses. A lot of that is the books I've bought. And so when looking at that, I've sold 100 books this year. So you say about like $300 worth of expenses of books. So I have about $1,500 of assets. So, we're actually doing pretty good. We're in an operationally positive year thus far for the book industry. But it's nice to see that as a general expense to really keep my profits and losses in line still. I want to be at a positive operating income with my general expenses being booked still. So I need to overcome that. but I also have to understand I have to keep buying books and good books to continue to have the good inventory. But at the end of the year, it's going to be looking a lot more profitable than what it was last year for myself. And the IRS is going to enjoy that. So how are we going to get there? How are we going to get at an operational profit with understanding my book buys being in general expenses, technically being assets? But how do we get this getting positive with that in mind? Co-signing books. So I had opportunity to co-sign some books with somebody. I'm in Salt Lake City, Utah. So the Book of Mormon's huge. The Book of Mormon and all its different variations and books out have different types of niche and value. Some can go for a lot of money. And so I got some books, some religious books from this friend of mine. He brought them over to my house. And what the positive thing is about co-signment is I'm not buying the books. I just sell them. So, the risk, not a whole lot of risk for me because I didn't buy the books. I just have to make sure we sell them and we split the profits 50-50. So I sold a rare 1908 Book of Mormon. That was for $225, and I sold a 1920 version for $64. Same buyer, going to Canada. And so at the end of that, when I get that delivered out tonight, minus the fees from eBay, the shipping costs and all that, me and the co-signer that partner together, we're going to be profiting about $150 a pop each, pure cash money. I didn't have to buy the books. He brought them over to my house. So the effort for me to get these higher quality books not only help the views to the store, helps my pockets as well. And my current estimated linear revenue, I say linear revenue because especially at the tail end of the year in Q4, typically sales go up because, holidays, people have money. So I'm in line right now. The goal is $25,000 in revenue for 2025, but I'm in line for 21,000 right now. And I think I still get to 25 as I go along. Not only the compound effect from Q4, but just the compound effect of me becoming a better bookseller, me having more inventory. I'm always growing my inventory. So I can see that number, skyrocketing up, especially if I get getting good books off co-signment and such. So we're really in line. D.A.T.A, the stock, the fake stock on OTC, D.A.T.A is real in line. We're doing a lot of great things, and I'm excited for where the book business is going further. And so that's kind of like the financial outlay of where we're at as a book company right now. We're getting them sales in. I'm always trying to get a lower cost per book when sourcing, and with these bigger buys and co-signment, we can do some damage. And so some business objectives I just want to talk about some of the keys. Is to continue to find the co-signment opportunities, very high margins, very little overhead. Obviously, this is a tangible business. This is a distribution inventory type of business in a lot of ways. But, we can take a lot of things, we can learn a lot of things from different industries. And in the software industry, they really try to find, avenues of revenue that don't take a lot of money for tangible assets. And they get that for subscription based, where, a subscription base is where a person pays a lot of money, a person pays money to get a service from the company, but there's no underlying tangible asset since it's online. And so while these are books and these are tangible, and this is not a software company, this is not a software industry, co-signment in a lot of ways mirrors what software companies can do. So co-signment is much like a subscription model in a sense, if you think about it. Very high margins, very little overhead. Where there's little overhead because you didn't buy the books, right? It's high margins because it's not your book. You're just using your platform as a service to the person who wants to sell the book. So you're just taking off the top. And if you have a good deal, that could be 50%. So those 2 Book of Mormon books I have, I didn't have to pay up for those at all. You know, the service to the person for me was he came to me, he says, I want these sold. You have a platform to sell them. Can I use your service as your platform? I said, okay, we'll do 50-50 minus the fees, and I get a high margin. That's just pure profit for me. The only thing I got to pay for is, you know, my time and effort to get them shipped and the shipping supplies, which aren't a lot. And so I'm happy with that model. You know, and financially, it's not too hard to, you know, keep that all in line. I don't think I'm going to have a large consignment business, but I'll be very specific and concentrated and condensed on what I want to do. I'm also running 99-cent auctions a little bit more frequently now, and it's just to continue to gain online market share, followers on eBay. And this is the phrase I have: customers to acquire from books I don't desire. And what my philosophy is on that is, you know, sometimes there are books out there that are in bad condition, but are still, you know, desirable titles, just bad condition. Or there's books that aren't worth a spot on my shelf on my store. You know, it might only be a $15 book to the right type of buyer for many of reasons, right? And so I'm trying not to put lower price books on my store. I'm trying not to. Sometimes with my sales, you know, that varies, but as I'm you know, getting more business experience, I want my price per book higher, right? But with the 99-cent auctions, I can get off a lot of books that might not be good for my eBay inventory store, my store, but I could maybe sell them for $1 or $2 on auction, you know, and I raise up the shipping cost to get a little of that money back. And, you know, sometimes when you cherry pick how I cherry pick, you're going to buy books at a little bit more of a costlier price. And instead of me, you know, keeping the books, looking at the books and just disposing the books because, you know, I don't know what to do with them, put them on auction for 99 cents to see if they sell. You know, at least you can cut down on the expense of that book. You know, if you paid a little bit too much about it, you can cut the expenses off that book. You get a little money back, but you're also getting that sale. So it's helping the item sold, and you're providing a good experience for that buyer, which also helps for positive feedback. And if we just look at my metrics right now, I have 44 followers, and I haven't been in business for a year yet. You know, I haven't been in business for a year. I'm going on, I think, month 9. Yeah. I'm going on month 9. So I'm 3 quarters in onto my book journey. So 44 followers, 99.4% positive feedback, and 374 items sold. I have 169 positive feedbacks. I have 1 negative feedback, and it was unfortunate because it was a book that I bought, you know, for $2, you know, months ago at a thrift store. I read it. It was from an author that is very popular, that has valuable books, but it was a self-published book by him. You can't find it online. And I read it, but it didn't necessarily resonate with me. So I was like, okay, it's not in my personal collection anymore. I'll sell it at a high price. I sold it for $137. I read that book. I understand that book. It was in amazing condition. But you have to protect your business, especially on eBay, because there's people on there that try to take advantage of you. And I wear this negative review as a battle scar, and I am proud of it because I'm pretty sure this person was trying to take advantage of me. They bought the book. I listed the book, and 2 hours later, it's sold. Full price, $137. He comes to me after the book comes in. He says, hey, I just opened the book. Everything looks great, but the book smells. Mind you, I just had the book. I read the book. It's been in my collection. It's been protected. I knew there was no smell there. And so I told him, okay, just allow the book to air out for a little bit and come back to me in a day or so. Well, I told him come back to me the next day to see if it still smelled. I just needed some air. And with older books, it's over 100 years old. Of course, they have some smell. So he doesn't reach back out to me. He reaches back out like 4 days later, and he says, "Hey, I took it to a restorer. They can get the smell out for $100." And he was asking for a refund. I don't do refunds unless it's for a return. He doesn't want to return the book, and so I think he was trying to take advantage of me. And I told him, "Sir, I've read that book. That was in my personal collection. If you want to get a refund, I need the book back, and you can get the full refund." He did not want to do that. He did not want to do a return. He was trying to get a little bit of a discount off the book. And he said, hey, he was threatening a negative review if I didn't do a little bit of a refund to counteract the cost he paid. I said no. And so he went on, he gave me a bad review. He said seller was pretty rude and was very disrespectful on messages, blaming me on things I did not know. How can I smell an item I've never even touched? The book arrived with bad odor. It was odor. It wasn't my fault. And later on messages, he says, why didn't you ask me in first place? I did not say that. I said, why didn't you reach back out like I wanted you the day after to see what the smell was? And he had a lot of excuses, and it just didn't make sense. He was trying to take advantage of me. How can I ask things I was not aware about? But the fact that I get blamed, sorry, not acceptable, very sad, oh well. Not a really well thought out review. But I wear it on my sleeve. You're not a real seller until you get a bad review. That's what my mentor says, and I'm wearing it. Whatever. We're still selling books regardless. We're still trapping out regardless, so that's fine. And another objective is I want to expand my inventory to foreign books. I sold a Vietnamese language book not too long ago, and I just bought a bunch of Vietnamese, Sanskrit, Buddhist books in different languages, and that's just to expand into different markets on eBay. A lot of people on eBay buy those type of books. I've been talking to some people, and so we'll see where those goes. And that's under $1 a book, and so I can just piece those out over time, very low risk. And again, those are sourcing larger curated collections. So I want to find collections like that. It doesn't have to be a Vietnamese books. It could be different type of style books. Like I had sports media guides and sports magazines I got for about $1 an item. So those are the type of things that you can grow your business off of that, have great inventory, low price, and you could just, piece them out over time. Now, I would like to do a free pickup sometime in the year. It's hard for me because I have a full-time job right now. And you have for free pickups, usually it's larger boxes. I have decent space, but it's not like I have a whole bunch of space to, have books that I don't even want and have to throw away anyway. So I like the cherry picking method. I like the method of having specific curated, collections that I can get. So the free pickup with just random books, that's not a model I want to continue, but I do want to get the experience to do so because I do think there does hold value to it. Building connections, networking, and providing a service that can lead to better, numbers in the future. So, that's Rare Books USA. Those are the business objectives. The business is going good. The month of February wasn't my best month ever, but with those sales the last couple of days on consignment, that boosted my numbers up a bunch. And we'll continue to monitor this as the months go on. But I'm very excited. So quickly, the Data Cap Divi pack. I only have one Dividend right now. It's N.A.T. Nordic American Tankers. It's an oil tanker company. The price right now at the stock is $2.63. My average share price is $3.34. I'm down $376, $76. The current yield estimated is 11.4% of the year. It's a pretty good yield. Overall, I'm very excited about this company still. The oil rates, the time charter rates for oil tankers, it's still at significant notable highs. Like 35,000 plus. when historically it's been under 30s and 25s. So a lot of the oil tankers in the industry is making a lot of money. This company, the CEO, believes in a firm dividend. The CEO and his son keep buying boatloads of stock. So I'm very confident, even with me down currently, I'll just continue to rack up the hefty dividend. N.A.T. Nordic American Tankers. Take a look if you haven't, and I will have a video on it at some point, in the next couple months, just going over the fundamentals again. So that's it for today, y'all. Hopefully it was a long one, but hopefully you guys got a lot of knowledge out of this. Obviously, I'm gonna piece this information through and send it on to my different channels. So like and subscribe, follow all my different channels, and you'll be seeing these pop up on the different avenues here shortly. But with that being said, Art Turner, D.A.T.A Productions Media. Dreams are tangible aspirations where we scheme our dreams to existence. I love you all, and I'll see you in the next video.